we saw last year, a number of challenges that were facing producers. I guess they only have a number of levers that they can pull, volume and price. Mm-hmm. Do you think they did enough, whether that bore fruit last year or will bear fruit this year?
I think from the producer's perspective, there are various levers that they can pull, as you say. The one major element that I think started the rehabilitation was the acceptance that goods were not required. From a producer, that's not particularly good news, to say the least. But the ability to take goods out of the marketplace but maintain operations this year has probably been helped out by the simple fact that the cost of operations has been falling. And if we look at the currency situation, we look at the operating currencies, a lot of these, or the currencies of the countries that these companies operate in, we've seen a devaluation. And that helps the overall cost of production to reduce. That takes a lot of pressure off of the need to sell more and more goods. It enables the companies to be more pragmatic. And if we'd seen an appreciation of these emerging market currencies, then it would have been more stress to produce more goods and sell more goods. But actually, it's enabling the balance sheets of the companies that are well capitalized to take decisions that have been for the benefit of the industry. And that, I think, has been a major element of companies taking production out.
And this concept of volatility, we it's used to in the diamond sector. I wonder almost whether volatility actually even exists anymore, whether that's just the new normal, that's what we have to accept, and what particularly producers can do about that.
But I think this comes back to the change the industry has had to undergo over the last 10, 15 years. The removal of a monopoly position means that the industry is more market orientated. It's more exposed to cyclical trends and the peaks and troughs that come with economic growth and contraction. And no longer can the industry look to Big Brother to bail it out. There can't be a complacency. There's got to be an acceptance that people have to look after themselves at any stage of the value chain and ensure that their businesses can withstand or at least make a return in the bad days and the good days. And it's imperative that people look at things in a more market-orientated way, and that's going to be how the industry will grow as a whole, because it'll become more well-capitalised, there'll be funding for better times, there'll be opportunities, and it'll be more in tune with the wider economy, global economy, because at the end of the day, the people that are buying the goods are exposed to the same economic trends now, and to correlate the two is probably the most advisable thing to do.
And particularly for miners themselves in a sector that takes so long to explore through to first ore to plant, it is an awfully long time. It's a very capital intensive process. I wonder the extent to which you believe that current prices being where they are, that will put off projects for the future, or whether you believe that producers are taking the right sort of prudent long-term approach to production and believing there's a fundamental demand long-term in the market.
Well, there's two very important points that you raised there. One, especially, I think investors, especially for the publicly listed companies, investors tend to underestimate the length of time that a reasonable sized deposit would take from exploration through to development through to production, and that whole time frame from start to finish, and then becoming a marketably commercially productive operation as well. They tend to the industry as a whole tends to underestimate that time frame. It also, at this moment in time, will put off investors, but those that know the industry very well will identify these times right now as potential opportunities. Projects will be valued significantly lower than they were 2, 3, 4 years ago. And some projects that are near to production would offer a considerable investment opportunity right now, or at least in the next 6 months, because there won't be the buyer tension. The capital won't be available for those that are less well capitalised. And there will be, I would imagine, a bit of a market share tussle going on, and there will be companies positioning themselves for the next 5 to 10 years, at least looking through to 2018, 19, 20, when one would anticipate prices continuing to recover.
And you touched on it a little bit there about this idea of consolidation in the sector. I mean, that may happen upstream, that may happen midstream. There's even talk about it happening down at the retailer level. Where do you see most consolidation happening?
Consolidation, I think, is as often occurs through stresses, financial stress or consumer stress, and I think we're going to see a lot more of that. Every aspect of the value chain will see consolidation, and a lot of it is due to the fact that there is a need for an improvement in margins, an improvement in profits, and to be such a disparate sort of offering dilutes the amount of profit generation as an industry. So you are inevitably going to see consolidation, and I think it's going to be at all ends, and we've seen it considerably at the retail side. We are probably very close to start seeing a tipping point in the producer side, and the midstream has obviously undergone a serious element of consolidation, but a lot of it has been sort of not been so public as the two other bookends.